Saudi Aramco cut its official selling price for Arab light crude by a massive $11 per barrel for Asian buyers. This represents the largest monthly price cut in over 2 decades, dragging Brent crude down to $72. For U.S. markets, this energy price collapse serves as a powerful disinflationary spark, directly easing CPI expectations and boosting hopes for Federal Reserve rate cuts. The $11 price cut for August loading was deeper than anyone expected. It signals a shift in Saudi pricing strategy, from defending price levels to competing aggressively for market share. In the physical oil markets, this price adjustment has immediately rerouted cargoes, indicating that the supply-demand balance is tilting rapidly toward oversupply. Behind the Saudi price cuts lies a major structural shift. China is no longer acting as the marginal buyer for global oil. In May, China's retail sales contracted by 0.6% year-over-year, marking the first annual drop since the pandemic lockdowns. A 16% plunge in automotive sales was the main driver, indicating deep domestic demand destruction. Financial indicators are reacting fast to the oil supply glut. WTI crude futures have flipped into Contango, meaning nearby oil is cheaper than oil for later delivery. At the same time, the 5-year TIPS breakeven rate has crashed 40 basis points over recent weeks to 2.26%, confirming that bond markets are pricing in a rapid collapse in inflation expectations. In corporate tech, Broadcom and Apple extended their custom chip partnership through 2031. This long-term contract secures critical wireless connectivity components, Wi-Fi and Bluetooth, supply for Apple's upcoming hardware. For Broadcom, which derives 20% of its revenue from Apple, this extension provides immense financial stability and long-term revenue visibility. Nvidia shares are digesting their historic gains. The stock's forward PE ratio has compressed to 19 times, its lowest level since 2018. Even as GPU demand projections remain elevated, the compression suggests the market is starting to demand concrete revenue results to justify further valuation expansion. Technological hurdles are also emerging. Rumors indicate that Nvidia's Kyber NVL144 rack-scale architecture is facing a delay of over 12 months, potentially pushing its release to 2028. The bottleneck involves manufacturing the complex 78-layer PCB midplane. While Nvidia maintains that its product roadmap is intact, the rumor has introduced caution regarding Rubin Ultra scaling schedules. Nvidia's hardware constraints are highlighting opportunities elsewhere. Goldman Sachs raised its price target for AMD from $450 to $640. Analysts cite accelerating custom ASIC design wins and rising GPU market share as cloud providers look for immediate alternatives to secure their infrastructure pipelines. AI infrastructure capital expenditure projections remain huge, reaching $800 billion in 2026 and $1.2 trillion in 2027. However, capital is beginning to rotate out of megacaps as investors look for valuation convergence in mid-cap and international companies that are adopting these productivity technologies. The broader software sector remains soft as enterprises scrutinize their spending. However, the market is bifurcating. AI-native beneficiaries and infrastructure monitoring firms like Datadog are hitting all-time highs, while traditional financial engineering and buyback-dependent models are facing pressure. OpenAI has entered conceptual discussions with the U.S. government regarding a proposal to grant a 5% equity stake to a public trust, modeled after the Alaska Permanent Fund. This strategic maneuver is aimed at sharing economic upside with the public, while securing regulatory clearance to protect its path to a $1 trillion valuation. OpenAI has confidentially filed draft IPO documents with the SEC, but is reportedly leaning toward delaying its debut to 2027. Advisors caution that market conditions may not support a $1 trillion valuation, particularly after SpaceX IPO investors experienced 30 to 40% drawdowns from their peak. Despite structural macro shifts, U.S. corporate fundamentals remain robust. S&P 500 second quarter earnings are projected to grow by 25% year-over-year. This strong corporate performance is supporting year-end S&P 500 targets up to 8,250, as lower energy costs provide a margin boost.